Look, we all know the absolute dream of passive income. You buy an asset and it just pays your living expenses while you sleep. Sounds amazing, right? But is that actually possible in the real world? Well, today in this explainer, we're going to put that dream to the test. We're building what we call a risk ladder of monthly dividend stocks, just to see if a single stock can actually pay your rent. Now, as we climb this ladder, every single rung is going to offer more monthly income, but, and this is a big but, it carries a completely different level of risk. And stick around, because by the end of this, I'm going to show you a stock that looks like it pays almost your entire rent, but actually hides a massive, dangerous trap that most investors don't see until their money is, well, literally gone.
All right, to make this real, we need a solid baseline. So let's introduce our hypothetical investor. We'll call him John. John's worked really hard, he's saved up, and he now has a cool $100,000 nest egg. And he wants to put this entire amount into a single monthly dividend stock. Now, quick reminder, unlike your traditional stocks that pay out every 3 months, monthly dividend stocks pay out on the exact same schedule your bills are due.
And honestly, what is the biggest bill most of us face every single month? Rent. Right now, the average American rent sits right around $2,000 a month. Now, obviously, I know this fluctuates wildly depending on whether you're in New York or Nebraska, but for our explainer today, this $2,000 is our core challenge. That's the magic number. Every single stock on our risk ladder is going to be measured against this exact target. We want to know how much of that $2,000 can John's $100,000 actually cover.
So let's start at the very bottom of the risk ladder with rung 1, Foundation of Safety, featuring realty income. And honestly, they literally trademarked the phrase, the monthly dividend company, which is a pretty huge flex.
So what exactly makes them the foundation of safety? Well, they're a massive real estate investment trust. Basically, that means they own over 15,000 commercial properties across America. We're talking Walgreens, Dollar General, FedEx warehouses, places you see every day. And get this, they have faithfully paid and raised their dividends every single year for 32 years straight. They sailed through the 2008 crash, the 2020 pandemic, literally every panic in between. But what's the trade-off, right? You are giving up yield for supreme safety. Realty income yields about 5.26%. So, on John's $100,000, he collects $438 a month. That safely covers about 22% of our rent target, just a little over a fifth. It absolutely ensures his money doesn't go backward, but, it definitely leaves us wanting more. If John wants to cover a bigger chunk of that rent, he's got to step up the ladder.
To climb higher, we kind of have to leave traditional real estate behind and enter the world of BDCs, or business development companies. Now, the absolutely crucial thing to understand here is their business model. BDCs step in where traditional Wall Street and regular banks just won't. They lend money to mid-sized American businesses. So they borrow cash cheaply, lend it out at higher interest rates, and they just keep the spread. They essentially play the middleman. And the best part, by law, they have to pass the bulk of that profit directly to you, the investor, as a monthly dividend. This is our ticket to climbing a lot closer to that $2,000 goal.
Moving right along to rung 2, the BDC gold standard. Meet Main Street Capital. This is a $4.7 billion giant with a massive survival record. I mean, they never cut their regular monthly dividend through the crashes of 2008 or 2020.
Taking this step up the ladder brings us Main Street's 8.47% yield, which bumps our monthly income up to $706. So we are now covering 35% of the rent. Over a third. That's solid. But I do have to warn you about something we call the BDC trade. See, Main Street is internally managed, which, by the way, is a vital detail we'll unpack in a second, meaning the folks running it work directly for the shareholders. But even with that huge advantage, while Main Street's dividends survived all those past recessions, its share price actually temporarily plummeted by 40 to 50% during market panics. So here's the reality check. Surviving the dividend is not the same thing as surviving the share price. You really have to be able to stomach that kind of volatility.
Now, if John is willing to stomach that volatility, we step up to rung 3, the smaller sibling, Capital Southwest. They use the exact same lending model as Main Street, they're just about a third of the size.
Because they're lending to the exact same kinds of mid-sized companies, but trying to grow a bit faster, the reward for stepping out of your comfort zone definitely increases. Capital Southwest posts a 10.99% yield, which pays John $916 a month. I mean, we are officially filling almost half the rent target. But you knew there was a but, right? Here are the catches. A smaller size means fewer loans, which means less diversification. Just a few bad loans are going to hurt them a whole lot more than they'd hurt a giant like Main Street. Plus, smaller size also means fewer buyers and sellers in the market, which leads to much rougher price swings whenever the market gets a little nervous.
All right, now we step dangerously close to the edge of the risk ladder. Rung 4, living on the edge with Saratoga Investment. This is a tiny $360 million BDC that lends to even smaller, riskier companies just to squeeze out higher interest rates.
But hey, before we even look at the payout, we really have to talk about the structural cliff we've just reached here. Remember earlier how I mentioned Main Street was internally managed? Well, Saratoga is externally managed. Basically, this means a completely separate firm gets paid fees to run the portfolio. These outside managers make more money as Saratoga's portfolio grows larger, totally regardless of whether you, the shareholder, actually get any richer. It's kind of like paying a captain based on the size of his ship, even if he's actively sinking it. It's a huge structural conflict of interest, and honestly, a massive risk variable added to John's portfolio.
So why on earth would anyone take that risk? Well, here is the reward for surviving the edge. Saratoga throws off a massive 14.67% yield, paying John $1,223 every single month. We have officially knocked out 61% of our $2,000 rent target. At this point on the ladder, the income is undeniably real, the business model functions, but man, the risks are highly, highly elevated. In fact, this is the absolute limit of justifiable, knowable risk on our entire ladder.
Which brings us to the climax. Rung 5, the $1966 tease, Pennant Park. This is another BDC in the exact same lending space, but the numbers here are just completely staggering. Pennant Park boasts a monstrous 23.59% yield.
Think about that. For John's $100,000, that translates to an unbelievable $1,966 a month in pure cash. That almost perfectly fills the entire $2,000 rent target. From the exact same $100,000 investment we started with way back at the bottom of the ladder, we are now looking at an income stream that essentially pays the average American rent in full. No way, right?
But hold on, stop right there. If Saratoga was the absolute limit of justifiable risk, we really have to ask the critical question. What changed? How on earth is Pennant Park's yield almost double the highest yield we could reasonably defend just one rung down?
Okay, to answer that, we got to put our finance hats on for a second and demystify what's called the yield trap. Look, yield is just a simple math fraction, right? It's the annual dividend payout divided by the share price. So logically, there are only two ways a yield goes up. The good way is when the business genuinely grows and the company pays out more cash. Awesome. But the bad way is when the share price absolutely collapses and the dividend just hasn't dropped quite as fast yet. So the yield percentage looks like it's skyrocketed, but in reality, the underlying asset is just plunging in value.
Let's map out Pennant Park's devastating history just to see which one this is. Spoiler alert, over the last decade, this stock has been a falling knife. In 2016, they paid 28 cents a share per month. In 2017, they slashed it to 18 cents. In 2020, down to 12 cents. And in late 2023, they brutally cut it down to just 7 measly cents. So that flashy 23% headline yield, it's a total illusion. It's actually hiding a 75% destruction of their monthly dividend over the last 10 years.
And let's look at the grim mathematical reality of this trap. If John chased that massive headline yield, the dividend cuts aren't even the worst part. Historically, Pennant Park loses nearly 5% of its share price every single year. So after 10 years of this share price decay, John's original $100,000, his hard-earned nest egg, would melt down to just $64,717.
And the really sad part? As that underlying capital shrinks, the monthly income inevitably shrinks right alongside it. If we map out the decay, that glorious $1,966 a month drops all the way down to roughly $1,272. The very stock John bought to pay his rent slowly stops paying his rent, and it drags 35% of his hard-earned net worth down the drain with it.
So let's do a quick recap of our ladder based on what you, the investor, truly need. Do you need absolute safety where your capital is protected over a long timeline? You go with realty income. Do you want meaningful rent coverage with moderate risk where you're okay stomaching some price swings for steady dividends? That's Main Street and Capital Southwest. Do you want to push it to the absolute risky edge? Saratoga. But Pennant Park? That right there is the ultimate yield trap.
Which brings us to our final thought for today. The next time you're looking at a dividend stock and you see this massive rent-paying yield, you absolutely have to look past the headline. You need to dig into the mechanics of the payout and ask yourself the hardest question in investing. Are you buying real, sustainable income, or are you just slowly buying back your own capital?